What's up, everybody? It's your boy Sad coming to you with today's stock pick, news, and indicator help. No face, just facts in 5. I do the research so you don't have to. Make sure you check out the new Stocks by Sat '06 live stream, where we keep a live feed running on some of the top stocks and indices in the market, plus a stock of the week. This week's stock of the week is SpaceX. Shout out to 11 Labs for making every video possible. Link in the description and profile. Let's dive in. Today we're talking about one of the most important lessons for beginner investors: buying at the top versus dollar cost averaging. And we're using Meta as the example because this chart tells the whole story. Meta ran up, got crushed, scared a lot of investors out, then recovered in a major way. So the question is simple. If two people both invested $1,000 into Meta starting near the 2021 top, who came out better? The person who bought all at once or the person who used DCA or dollar cost averaging? Here's the setup. Person A invested the full $1,000 on September 7th, 2021 at the market open, when Meta opened around $376 per share. That gave person A about 2.66 shares. Person B started the same week, but instead of buying all at once, person B invested $20 per week for 50 weeks, buying on the first trading day of each week at the opening price. Same stock, same total investment, same starting period, but a totally different strategy. Now here's why the dip changed everything. Person A bought near the top and had no averaging down. So when Meta started falling, person A's average cost stayed stuck around $376. That means person A needed Meta to recover all the way back toward that original entry before the position really started looking good again. Person B had a different experience. As Meta kept dropping through 2022, every $20 buy purchased more shares at lower prices. Person B was not predicting the bottom. Person B was simply staying consistent while the price was falling, and that lowered the average cost. Now let's look at the results. Using the backtest estimate, person A invested $1,000 in one lump sum and ended with about 2.66 shares. At Meta's recent price around $550, that position would be worth about $1,462. That is still a gain because Meta recovered strongly. But person B invested the same $1,000 across 50 weekly buys and accumulated about 4.27 shares, with an average cost around $234. At the same recent Meta price, that position would be worth about $2,348. So both investors made money, but person B finished with roughly $885 more from the same $1,000 investment and saw an over 200% gain. That is the lesson. Same stock, same total money invested, different average cost, different outcome. Person A was not wrong because Meta eventually recovered, but person B had the better setup because dollar cost averaging bought more shares when the stock was cheaper. That is why average cost matters so much. When you buy all at once, your entry price is your entry price. But when you average in over time, your average cost can move lower during a drawdown, and that gives the recovery more room to work. Now let's be clear. Dollar cost averaging is not magic. It does not save every stock. It worked in this example because Meta survived, recovered, and eventually moved much higher. If a company is broken, drowning in debt, constantly diluting shareholders, or heading toward delisting, averaging down can just make the losses bigger. So the real lesson is not keep buying anything that falls. The real lesson is average into quality, not garbage. Dollar cost averaging works best when the asset still has a strong long-term case and the decline is more about fear, volatility, or temporary pressure than permanent damage. This is where a lot of retail investors get confused. They think the goal is to perfectly time the bottom, but most people will not do that consistently. The better goal is to build a position in a way that gives you room to be wrong on timing. Person B did not need to catch the bottom. Person B just needed discipline. Every week, $20 went in. When the price was high, it bought fewer shares. When the price was low, it bought more shares. That is the power of dollar cost averaging. It turns volatility into a tool instead of just something to fear. Here's Sat's take. For quality assets, dollar cost averaging gets a 9 out of 10 investor lesson. Buying the top hurts, but it does not have to destroy the entire strategy if you are patient, consistent, and investing in something that can recover. Meta is a perfect example because the lump sum investor still won eventually, but the dollar cost averaging investor built a stronger position by lowering the average cost through the dip. The big takeaway is simple. Time in the market, consistency, and average cost can matter more than trying to look like a genius on the first buy. Remember, I'm not a financial advisor and this is not financial advice. Do your own research, manage your own risk, and never invest what you can't lose. Don't forget to smash that like button, subscribe, and drop a comment with a stock or indicator you'd like me to cover next. This is Sat, and I'll catch y'all in the next one. Peace.